Now we show how to use the option strategy optimum tool for finding a maximum expected return strategy following a neutral market sentiment. In the case of a neutral market sentiment, we need to use neutral strategies, which are either sideways strategies or volatility strategies. In the case of sideways strategies, we believe that the stock market price will be inside a certain interval. That's why the profile look like mountains with a peak or a plateau. Simple examples of peak strategies are a short straddle or its protected counterpart, a long butterfly protection from both sides, and the front spread, which has a protection only from one side. And simple examples of plateau strategies are short strangle, its protected counterpart, long condor, and a short ladder that has a protection also like a front spread from one side. And in the case of volatility strategies, we believe that the stock market price, vice versa, will be outside of a certain interval, that their profiles look like flippings of sideways strategies, and they look like ravines or like valleys. A simple example of ravine strategies are a long straddle, its restricted counterpart short butterfly, and a back spread. And simple examples of valley strategies are long strangle, a short condor, and a long ladder. Let us first generate sideways strategies, which are peak strategies. For this purpose, let us choose direction type sideways, and we will be using options on the IBM stock today on August the 18th of 2020, taking options from the option chain expiring on September the 17th of 2020. So the expiration is 1 month away from the current date. We will be using options from the domain with 12 strike prices starting on $95 and ending on $150. As before, we will be using a maximum of 4 option contracts. To produce a maximum expected return strategy with a fixed peak at a certain strike price, we need to click on the vertical line at the strike price and push the button maximize expected return. What we have here? Here we have a put front spread with expected return on $158.96. What it means? It means that all peak strategies that have the peak at $95 strike price will have this expected return or lower. Trying each of these strike prices in the domain, we will find the maximum expected return strategies with a fixed strike price. So, and we'll choose the best one. So if we use the strike prices closer to the middle of the domain, we will be producing butterflies actually with unequal wings like this one, or equal wings. This one is iron butterfly because it involves call options and put options. It has negative expected return and probability of profit 33.86%. The strike price $185 will produce us a regular butterfly with equal wings. It is actually a long call butterfly, still negative expected return and very small probability of profit. But the strike price of $135 will produce us a strategy, a big strategy with already a positive expected return of $32.76. It is a long call butterfly with unequal wings. But we will see that clicking on the strike price of $145 actually will produce us the best strategy with expected return of $288.55 and the probability of profit of 56.75%. The left wing will give us the maximum loss of $653.95, and the right wing will give us a profit of $1,346.05. If we click on the last strike price in the domain, it will produce us again a call front spread, but with much lower expected return. So the strike price of $145 will give us the best pick strategy in the sense of maximizing expected return. To generate maximum expected return, Plat Strategies, we should act in a similar way. We need to push on a certain strike price that we want to be the left end of the plateau, push the button, hold it, and move cursor to the right, and release the button at the strike price that we want to be the right end of the plateau, and click maximize expected return. And now we have a Plat strategy, which is actually a ladder, put ladder. This is a long put ladder with negative expected return, and this is very negative expected return. But if we try other strategies in the similar way, we will have better or worse strategies which are actually condors with equal wings, like this one. This is a long put condor, or we have condors with which are very bad, that do not have any chance to have a profit, because it's under the zero line in total. So these condors with unequal wings, with positive expected return and 33.86% of probability of profit. But trying to different platters between strike prices, we will see that actually narrower platters will give us a better result, and the platter between strike prices $140 and $145 will give us the best result. So click maximize expected return, and we will have the Plat strategy with expected return of $189.21 and probability of profit 56.75. The left wing will give us the maximum loss of $325.95, and the right wing will give us a profit of $674.05. So if we compare with the pick strategy, the best pick strategy that we found before, we'll see that the pick strategy is much more aggressive, because the right wing will give us a twice more profit, but the left wing will give us twice more maximum loss. So if you are a risk seeking person, then you probably will choose this pick strategy to trade. But if you're not risk person and try to avert the risk. Among sideways strategies, probably you should choose this Plat strategy with expected return $189.21. So, and this is it. In the next uh, section, we will consider volatility strategies. To produce volatility strategies, we should choose the direction type volatility, and we should act actually in the similar way. To produce ravines, we need to click on each of the strike prices and find ravine strategies and compare the expected returns. For example, here, clicking on $95, we produce the ravine strategy, which is actually the knee straddle. You see this knee, and this straddle is a long straddle, and see the expected return is really positive. It's already thousands of dollars. It's $2,500 and 98.25 cents, and this expected return looks much better in comparison with sideways strategy, the sideways strategies that we found before. So this means that probably sideways strategy is not a good idea. Probably this volatility strategy is better for the stock at this moment. So let us try strike price 100, and again we have a knee straddle. Next strike will give us again another knee. But you see the expected return is decreasing. So next one give us even another knee. This is another knee strategy, but if we click on the strike price 125 with this closest place to the current stock price, will produce actually the strategy which is a strap with expected return 3306.36, and this is actually the best volatility strategy among ravine strategies. So if we move to the right, we already produce strategies with a lower expected return. Um, so and this straddle has two knees. See, one knee is here, one knee is here, and we click on the last strike price. We produce again another knee straddle, but with lower expected return. So the strike price of 125 will give us the best ravine strategy with the expected return 3306.36. Again, if we try to produce the valley strategies, we will have the strategies again with at least $2,000 expected return, and narrower valleys actually will give us a better expected return. Like in this particular case, this valley strategy is the best among all valley strategies for this particular domain. It has $295.65 expected return and pretty high probability of profit, 72.21%. So again, if we click on strike price 125, we will see that this strap is much more aggressive, and because the maximum loss is $1,361, but if we look at this valley strategy, it has a little bit less expected return, but um, much lower maximum loss. So this strategy is even better. Oh,